With the FOMC meeting looming on the horizon tomorrow, stocks closed largely flat today. The exception to that was the Russell 2000, which was down over 0.5% today, and which led it to now have a bearish intermediate term posture, unlike the other three major indices. We also saw a major announcement from an earnings perspective after hours. FedEx came out. That stock has been beaten up pretty badly here recently. It continued falling in after hours trading here today. So that kind of impacted the industrial sector negatively as well. But I wanted to focus on a better performing sector, the technology sector, in our trade application example for today. So let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's March 19th, 2019. First of all, if you're new, welcome aboard. Remember to go to our YouTube channel, click subscribe, and while you're over there, go to the description area where you can sign up for our email distribution list. We're also heavy users of Twitter. We'd encourage you to follow us there. My handle is @BrandonVanZee. And anytime you see these Market Outlook posts floating around, we'd encourage you to click like and retweet if you get value out of these daily videos. In addition to that, we also have a presence on Facebook. We would encourage you to go to the web address embedded in the logo in front of you. All right, let's go ahead and dive into the charts. As you can see, I've got chart 4B pulled up here in front of us for those of you that are premium Market Scholars members that want to follow along at home in your own charting package. Keep in mind that we are looking at four major US-based equity indices to give us a sense of what's happening here in this particular country. Things might be a little bit different depending on what part of the world you reside in, but this can at least give us a good feel from a developed market perspective. And as I mentioned in the intro, things were largely a yawn here today for the most part. You'll notice that the S&P 500 was basically flat here today. SPX closed down by 0.01%. The Dow Jones closed lower by 0.1%. The NASDAQ Composite closed higher by 0.12%, and then as I mentioned earlier, the Russell was a little bit of an exception to the rule. The Russell 2000, which tracks small cap stocks here in the United States, was down over 0.5% today. It was down 0.57%. And here's what I was referencing before as well. Notice that with that sharper pullback in the Russell 2000, you now have that pink background color on the chart back there, signifying that we now have a weakly bearish posture. Remember, it's not a strongly bearish posture, so we could easily see this flip back to bullish if we get some good news out of the Fed tomorrow or what have you. But as of right now, it is striking a more cautionary tone. And remember, that's largely been the case here in recent weeks anyway. The Russell 2000 was the one index that hadn't given us a bullish crossover on the 1040 crossover method as just one example. So again, the Russell 2000 seems to be the laggard here within the indices in the United States. NASDAQ Composite seems to be the leader. Notice that we hit a multi-month high in the NASDAQ today, and of course what separates it from the S&P 500, which can make the same claim, is that the NASDAQ actually closed higher today, whereas the S&P 500 did not. We've also seen very strong technology price action from a sector perspective, and as many of you are aware, the technology sector is the most important sector to the NASDAQ Composite, so that's kind of helping pushing that particular sector a bit higher. Let's go ahead and take a look at our next chart setup now. This will be chart 4C, and this will be our three green arrows chart setup, looking at the four same indices here that we looked at a moment ago. Each one of these charts is 3 months in length. Each one of the candles is 1 day in length. And where we stand right now is that two of the indices have 3 green arrows and 2 of them do not. The two that have those 3 green arrows are the S&P 500 and the NASDAQ Composite. Notice those green background colors right there. And to catch everybody up to speed, in case you're not familiar with the term of 3 green arrows, what we're looking at is 3 different technical indicators that help us lead to stronger charts. And as you can see, we've got a green arrow here on the moving average when price closed above the moving average. We got a green arrow on the MACD down below telling us that momentum is kicking into the market. And then we had a phantom green arrow down below on the stochastics letting us know that the bulls have largely been closing the market near the top ends of the range as opposed to the bottom ends. And you can see that that same condition exists down here with the NASDAQ as well. However, on the right-hand side of the chart where we have the Dow Jones and we have the Russell Russell 2000. Notice the background colors there are white, signifying that we have kind of a more mixed message there. It's not quite as strong as what we're seeing in the S&P 500 and the NASDAQ. And part of the reason behind that, in fact, the reason behind that, in both cases is the fact that we have a red arrow on the MACD in both the Dow Jones and also the Russell 2000. So the momentum that we've seen with the NASDAQ Composite and the S&P 500 has not been quite as prevalent with the Dow Jones Industrial Average, largely because of Boeing in recent weeks, and then the Russell 2000, which has its own set of worries there that it's working through. Let's go ahead and take a look at our next chart setup, which is 4D. This will be our 1040 crossover method. I kind of hinted towards this earlier, but I'll just reiterate it now that we have a good visual here. Notice down in the lower right-hand corner, this is again the Russell 2000. Notice that is the only chart that has that pink background color, signifying that we do not have a bullish crossover quite yet when looking at the 1040 crossover method. And remember, we're looking at a weekly candle chart here. So each one of these candles represents 1 week in time. And we're going back 3 years to look at a longer time period here. And so ever since basically late October of last year, we had a bearish crossover on the Russell 2000, and we still have not crossed over bullishly to the top side. Whereas that has been the case with the Dow Jones, the S&P 500, and the NASDAQ Composite. So again, another sign that U.S. small cap stocks are considered kind of the laggards of this current marketplace. Moving right along, we're going to take a look now at our 12 grid analysis, starting with our intermarket analysis. And remember, the background colors of each of these charts will signify whether we have a bullish or a bearish posture using that intermediate term line on the market forecast technical indicator. And remember, this is chart 4E for those of you that are following along at home as premium market scholars. All right, so as we look at this, you can see that we have kind of a mixed bag in terms of bullish versus bearish postures. Our bearish postures right now are the VIX, which is struggling to say the least. It was up 3.5% today. However, we are very close to multi-month lows as it stands right now. So there's not a whole lot of fear in this marketplace, or at least there hasn't been recently. When it comes to the 10-year Treasury yields, we also have a bearish posture there. Remember, TNX will allow you to track the yields themselves. Right now, the 10-year Treasury is coming through at about 2.61%. Immediately below that, you have TLT, which also has a bearish posture. However, its price action is holding up a lot better. Notice that price is hanging out at around that moving average, whereas TNX is down below that moving average. So you will see this every so often where they will share the same posture, but the price action will kind of be inversely correlated to one another like you would assume. I would look at TLT as a possibility for an iron condor. I've mentioned that in previous market outlook videos in weeks past as well. I continue to think that way. As you can see, TLT has been trading in basically a sideways range here for the last 3 months. And right now I'm not seeing a breakout in either direction. So that could still be a source of potential iron condor trades there. The US dollar is the final one that has a bearish posture, and that's a little bit more of a surprise. This one has shown a tendency to carve out higher highs and higher lows. Now, we still have that possibility, but our chances are drying up. And what I mean by that is, you'll notice that we put in our most recent higher low on February 27th, right here on this candle that I'm kind of pointing out at in the lower left-hand corner. And where we stand right now is below that rising moving average, but it's not quite to those levels. So we'll be eyeing those levels. If we can get a bounce before then the assumption would be we will then go up and break this high that was set on March 7th. But until then, we're just waiting for that bounce to occur. And that's the whole idea, right? When you have a trade setup that looks like this, you wait for the bounce. Some of you are familiar with the term hold, or close above the high of the low day. You're waiting for the low day to set in stone and then waiting for the next day to bounce above that. Right now, we're still waiting for that low day to emerge. Could it be today? Possibly, but we don't know. Could be tomorrow too. We won't know until we see a legitimate bounce take place. So we'll be keeping our eye on the US dollar as well. Notice that the commodities are exactly the opposite of the dollar, and that's typically what you will find. In other words, the US dollar has a bearish posture. Gold, ag commodities, and crude oil also all have bullish postures. Remember that the U.S. dollar is very important in the world of commodities because most commodities are priced in U.S. dollars. So when the U.S. dollar is strong, oftentimes commodity prices are weak, and you also have vice versa. We actually talked about the ag commodities quite a bit, some of my background growing up in rural America, in my dividend growth investing class here today. So for those of you that are premium market scholars, if you want to hear my take on the ag commodities and how they might impact certain publicly traded companies that pay dividends, feel free to check out that recording that is now posted on our events calendar from earlier today. Let's go ahead and take a look now at our next chart setup, which will be our foreign stock market setup. This is chart 4F now. As you can see here, things look pretty decent. The only pink chart on the board is down below in the lower right-hand corner, and that's South Africa. Notice that one is a little bit still worrisome, at least in my eyes. What I see developing here is a reversion to the mean after an oversold cluster signal there with that green dot, so that is to be expected. However, I'm not automatically assuming at this point that this one is going to turn up roses. Now, obviously, every day comes with more information to process and to evaluate charts by, but as of this moment in time, I'd be a little bit concerned about this for multiple reasons. First of all, the moving average itself is downtrending. That's why we have that red color to the moving average. Price is below a falling moving average right now, and that's your 30-day moving average that we're using in this particular case. In addition to that, we can see a clear pattern of lower highs and lower lows. We had this high over here set by these overbought cluster signals, these red dots, that kind of called the top in this particular chart. We went down to this level to form kind of a new low, went up but couldn't rally back to those prior highs, established a lower high, went lower to now create a lower low below this area back here, and now we find ourselves bouncing with yesterday being an up day, but have not breached the moving average itself, and then today to the downside, 0.83% to the downside for South Africa, gives you the impression that it just doesn't have the fight in it right now to kind of bust this trend of lower highs and lower lows. So I'd be very cautious around South Africa at this current juncture. Many of the other charts are looking quite a bit more promising. We've been talking about India a lot recently. I mean, that is spectacular, what we've seen out of India, particularly given the circumstances of the start. At the start of that trade, we were in a bit of a downtrend right there, but about February 19th, until where we're at right now, we've just gone up in basically a straight line. So I don't know if that's geopolitics taking hold there, or economic reforms, or good earnings reports for Indian-based companies, or what's causing that. But what I do know is there is extremely strong price action in India right now, so it might be worth paying attention to. We also have strong price action out of China. We're near multi-month highs in China at this current juncture. I also am impressed with what's going on in Germany. Notice the German chart broke out to new multi-month highs here today. We did close kind of at the lower half of that candle's range, so it's not perfect, but nonetheless, our closing price in Germany was well above the prior high that was set in place here on March 1st. Same thing can be said here in the United Kingdom. That's a very strong move, bounce off of that rising moving average, new multi-month high out of the United Kingdom. So a few of these foreign stock markets are starting to collect a little bit of strength here, and might be worth pursuing for those of you looking for bullish trade setups. Let's now take a look at our next chart setup, which will be chart 4G, and this will be our U.S. sectors 12 grid here. All right, so as we take a look at this, notice we do have two pink charts on the board. The first one is communications up here, which just went pink today, or in other words, has a bearish posture using the intermediate term line on the market forecast. And I think part of the reason behind that is media. I'm not sure if you guys noticed some of the media names here today at all, but just to give you one example, Disney got blitzed here today. Of course, one of the largest media companies out there. There was a number of transitions taking place with Fox assets here today, and it closed lower by over 3 to 4%, somewhere in that vicinity. and you saw Verizon pull back and a few others within that communications space itself. So I think media is largely to blame for the weakness here within communications recently. And then down below here with the industrials, keep in mind that Boeing is part of the industrial sector. Remember that from the global industry classification standard system with the 11 different sectors, transportation is not a separate sector. It would be considered a subsector. So the subsector of transportation is within the larger sector of industrials. And so when you see industrials being one of the weaker sectors here recently, and one of the only ones with a bearish posture, part of the reason behind that would have to be Boeing and its impact, its negative impact compared to what's been happening with most other stocks out there. This market has been resilient to the upside. Boeing has been a rare exception to the rule to the downside. In addition to Boeing, I mentioned FedEx in the intro as well. They came out with their earnings announcement here earlier today. Let me show you what the chart looked like prior to that. It actually doesn't look that terrible. However, after hours, things are changing a bit more. So FedEx, if I were to show you the chart here now, this is in real time, and this is about an hour after the market is closed. We're at 172 as a last traded price on FedEx. It closed the regular session at 181. So that's not going to do the industrial sector any favors starting tomorrow in all likelihood. Now, obviously, it's after hours. Who knows? Maybe tomorrow morning there's, some positive brokerage upgrades on FedEx or something along the lines to reverse its course. But as of this moment in time, it appears that FedEx will negatively affect the transportation stocks, which will negatively affect the industrial sector itself. But going back to the rest of the charts here, you can see many of them still look reasonably strong. Utilities were down. They were the worst performer of the day, down over 1% today, but they retained their bullish posture and they're still above that rising moving average as well. The other thing that I wanted to point out is that technology just keeps on humming along. Notice that technology, XLK, that's your chart in the upper right, is up nearly 20%. It's about 17.5% right now, just in the last 3 months alone. So it's been a really, really strong rally, especially off the lows that were placed right here when we got these oversold cluster signals right around Christmas Eve. So technology has been one of the leading areas of the market recently. In fact, if I come over here to the internet, this is the sector selector that I produced last Friday. So it's got a couple of days of dust on it at this point, but can still be useful in our conversation here because look at what happened week over week. From March 8th to March 15th, technology went from number 2 back up to that number 1 slot, kind of reasserting itself as the king of the market right now. Whereas you find stocks like the energy sector kind of struggling to figure out where it wants to go, pulling up the rear in last place right there. Also, as a reminder, when you're on our website, remember, those of you that are premium market scholars can access this sector selector whenever you want, including the bottom portion that shows you all of the rankings for the individual stocks themselves. You can access that on our blog portion of our website over at marketscholars.com. You can also watch this Market Outlook video while you're over on the blog portion of marketscholars.com, and we make it nice and convenient for you over there to click like on Twitter and to give us a thumbs up on Facebook as well. For those of you that want to see us continue to do these videos on a daily basis, on a complimentary basis going forward as well. All right, let's go ahead and dive into our trade application example now for the day. After knowing that technology has been kind of a leading area of the market, I did want to focus on a technology stock for today's trade application. So I'm going to come on over here, take a peek at ticker symbol CRM. Many of you know that this is Salesforce.com, kind of a unique ticker symbol there, Customer Relationship Manager, and they've been one of the true growth stories of the market. You know, if you were to pull up a 10-year chart here, it's truly astonishing what they've accomplished in the last 10 years. You can see this was a $7.50 stock over 10 years ago. So $7.50 to $163 where we stand today. yes, I would call that a success. That was quite a remarkable feat that it has pulled off there. So for those of you that live in San Francisco, you'll know that they have reshaped your skyline as well as one of the largest, if not the largest, skyscraper in the city of San Francisco here that was just put up over the last couple of years. So Salesforce has been a remarkable story, Mark Benioff and company. What you can see taking place in front of you as we zoom back in now to the 3-month chart is that we've kind of regained our bullish posture on Salesforce back here on this candle, which would have been March 12th. So we're a few days past that, so we're not Johnny on the spot in this particular case. However, I would point out that today was a very strong day for the stock. Notice that we were up 1.22% today. Remember, the stock market itself finished flat. So clearly this candle had a path of least resistance to the upside. In fact, you closed in the upper half of the range right there. Yet we're still awfully close to that rising moving average. So when we have situations like this where we recognize strength out of a chart, yet we're not extremely far away from a moving average, those can oftentimes be interesting setups for what's known as a bull-put spread, where you're a seller of premium and you can hopefully see that the moving average itself will protect your trade from going against you. In other words, if you can get a break-even point below the moving average, and if you expect the moving average itself to act as some sort of a support bounce area that will prevent the candle from going down to your break-even point, it can work out. Now, obviously, I have no idea if that's going to happen in the future for Salesforce or not going forward. A lot of it will depend upon whether the stock market can continue to go higher or not. But generally speaking, it can be an interesting educational trade setup. So let's go ahead and take a look here at our trade tab. I've got CRM pulled up here. I'm going to concentrate on the April monthly contracts here with 30 days until expiration. On the right-hand side of the Thinkorswim platform is where you will find the puts. Typically, we are looking for a delta that's close to 30. In this case, you can see that we've got a delta of 27. That puts us in alignment with the 157.5 strike. So that would be the strike that we look to sell. And then we will likely look to buy the 155 to combine those two strikes to formulate this bull put spread. Some of you will refer to it as a credit spread. Some of you might refer to it as a short put vertical. There's a lot of different ways to describe it, but oftentimes I just call it a bull put spread. And so as we look at this, what we're going to try to do is we're going to right click on the 157.50. Then we're going to go over here to sell and we're going to choose vertical. That loads up our trade down below, and as you can see, we would be short the 157.50 put. Again, these are the April contracts, and we would be long, that's what that +1 stands for right there, or the buy over here also stands for. We're long the 155 put. Now, some of you might be wondering, well, why are you buying a put if you are bullish on this stock? Remember that by buying the 155 put, think of it as kind of a built-in insurance contract for this trade, and things in case things go dramatically wrong against you, right? We looked at that chart a moment ago, and it looks like the stock is doing well and bouncing higher. However, that can change quickly, especially with technology companies. If we find ourselves with this company, you know, at $140 a month from now, that's probably not going to do us too many favors if we were just short the put all by itself without also owning a long put. And so that's the intention of establishing a trade like this. The short put, in this case, the 157.50, will still be driving the trade. That's where we get our credit. We have to spend money out of our pocket to buy the 155 long portion of the trade, but that's our built-in insurance kind of hedge from that perspective. So as long as this stock, which is currently close to $164, stays above 157.50 through expiration day, then we should stand a pretty good chance of making money on this trade. Now you'll notice this particular spread right now has a credit of about 59 cents here. So if you click on confirm and send one time, you can see what the max profit is versus the max loss. If you get your calculator out here, you can take $59 here and divide it by 191. And that tells us that we would get about a 30.8% return on risk. And generally speaking, we're looking to get return on risk over 30%. So this trade would qualify from that perspective. notice that your break-even price would be 156.91. And so if I were to close this down for just a brief moment and go back to the chart, I'll show you if I can draw a line on here. So I'll draw a price level, and I'll show you where that happens to be. So edit properties, and let's take a look at 156.91 and hit OK. So that's where you're looking right there. So again, that's what I was referencing before. If you believe that this stock, which is currently in an upswing, will continue in that upswing, you would then have the rising moving average itself to act as kind of a last resort. Think of those as your defenses there, where they're going to kind of hold the line right there in case the bears try to push this stock back lower. The bulls will hopefully be using that line to bounce that stock higher before it would get to your individual break-even point on this particular trade. So back over here to the trade tab, let's go ahead and click confirm and send again, and this time we will go ahead and fire that off. All right, well, I want to thank you for joining me here tonight. Again, we had a little bit more of a pullback in the Russell 2000, so that did go to a bearish posture. But the S&P 500 and the NASDAQ Composite and the Dow Jones retain their bullish postures for now. We do have some news and notes coming out of the FOMC meeting coming up this week, so be on the lookout for that. That can obviously have an impact on financial markets, including the U.S. stock market. So we'll all be looking at that, and I'm sure David will fill you in on this video, all of the insight that he is learning there as well, and he'll take good care of you here for the next few days. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.